In this video, I'm going to be evaluating most of the strategies that are used by traders when they are trading Forex indices. I'm going to evaluate these strategies on the synthetic market. Let's say you're trading synthetics indices. You can trade synthetics on Deriv and WellTrade. So today we're going to be catching spikes using those strategies, and I'm going to be showing you the easiest way you can trade using those written strategies. So if you are new to this channel, make sure you click the subscribe button and like this video. If you want to join to our Telegram channel, you just click the link that is in the description. You just click more on the caption, then it will direct you to our description, then you'll be able to join our Telegram channel. So basically, we are going to start with price action. I'm going to show you how to use price action. Price action usually works when we have what? When the market is trending to that direction. Let's say you want to catch spikes going up like this. Usually we can use what we call the breakout point, which is usually found when we have what we call a bullish flag. So usually you will use what we call, you're going to draw your trend lines. So let me plot my trend lines here and show you how to do it. The easiest way is to use a parallel channels. So for instance, let's say the market is going up like this. If the market is going up like this, we can draw our channel like this. It should touch that candlestick and touch the bottom one, the bottom part, which is here. So basically, we can say this is our breakout point. This is our breakout point. So as a price action trader, you will enter your buy positions here and enjoy this movement. But you can only do this if there is no resistance. For instance, here, we can see that at this zone, there's a lot of resistance. Let me try to plot it so that you can see the zone that I'm talking about. This is the zone that I'm talking about, right? You can see that this zone has got a lot of resistance. When I say resistance, I'm just showing you a zone where the market was failing to cross. Because here we can see that the market reached this zone and failed to cross, reached this zone again, failed to cross, reached this zone again, failed to cross, and reached this zone again, but failed to cross. So in the event that you want to use price action, we cannot use price action here. Why? Because this zone has got a lot of resistance. For instance, I'm going to show you something. Let's draw another parallel channel here and show you what I'm trying to elaborate here. You can see here, if we try to draw our parallel channel here on M1, trying to catch 1 or 2 spikes. When you analyze on 1 minute time frame, just to know that you're catching at least 1 or 3 spikes, right? So here we can say we have a channel where we have a breakout here. But after the breakout, check what happened. It dropped. That's why I'm saying you cannot use this concept when the market is at the area with a lot of resistance. So before you do anything, make sure that you are plotting your parallel channel when there is no resistance around that area and when there is what? A bullish movement. So you should always use at least two confirmations. For instance, here the market is bullish. Then we have another breakout point. So we have two confirmation that there's a chance for us to catch more spikes. But here the market is consolidating around a zone with a lot of resistance. So we cannot use this breakout as an entry point. So basically that is how you trade using this flag pattern. Then we move on to the next step. There are other people who will try to plot this thing whilst the market is dropping like this. If the market is now dropping like this, it is very hard for you to use this breakout strategy because usually it will be a fake breakout. For instance, here you can say we have something like this, right, guys? Something like this. If you see something like this, This is a very long descending channel, which means we cannot base with this kind of a channel, right? So basically, we can see that there's a very long descending channel, which means the market pulled back for a longer period of time. So which means for us to focus on this breakout point, it would be hard. Why? Because this might be a fake breakout, and as you can see, the market started to drop again. Even if it spiked again here, it is very hard for you to enter here because there's a higher chance that the market can go what can go to this to this zone. Let me draw that zone that I'm trying to elaborate here. Let me show you the zone I'm talking about. It can drop to that zone. So basically, it would be wise for you to wait for the market to reach this zone. What you need to do is you should plot a zone where the market wants change its channel. When we say the market has changed the character and or changed the channel, this is where we say we have a turning point. Because here we can see that there was a descending channel whereby the market was dropping, but now there is now an ascending channel where the market is now going up. So you have to identify the zone where there was that kind of a change, right? So here we can see this is the zone where there was that kind of a change and the market spiked going upwards. But if you want to enter buy entries, let's say you want to catch spike going up like this, you have to wait for the market to retrace back to that zone. Then you try to catch those spikes. Avoid entering trades here. Let's say you just say I have plotted my parallel channel here, then I'm saying there is a breakout here, then I try to catch spikes going up. Usually you will lose a lot of money because it will just give you one spike to raise your confidence and think that the market is going up. So you have to wait for the market to drop first to this zone, then you can try to catch your spikes the easiest way. So I'm going to also show you how you analyze the market on a bigger time frame. So basically, we're going to be using the H1, the hourly time frame. This is the one we are going to be using. So when you are now analyzing your market using the hourly time frame, here we'll be focusing on the type of candlesticks that will be formed. For instance, here we can see we have long bullish candlesticks, which are showing us that the market is bullish, which means the market is going up. You can see there is a higher probability that the market was going up. As you can see, it was producing very good candlesticks going up. Usually, you will know the confirmed direction by the body of the candlestick. For instance, here we can see that this kind of a candlestick is very small. It is a red candlestick, which means it was a bearish candlestick. It is a very small candlestick, as you can see, which means there is a lot of rejection around this zone, which means we cannot base with that kind of a candlestick. We have to wait for these kind of candlesticks, which give us more confidence that the market is moving to that direction. For instance, here there was a Dutch candlestick here, then there was another candlestick which was showing us a bullish movement. The market went up, but it rejected and closed around this zone. So it means we now have to wait for the retracement. So here we will plot another zone. Here we are just touching the wicks. Your zone should touch the wicks only because we are now using the H1 time frame. So here we can see that we have wicks here where we have some rejection. So we wait for the market to pull back to that zone again. Then we can enter our buy entries here and enjoy the upward movement. You should also confirm with the 1 minute time frame when you enter that trade. Then you are supposed to focus more around these areas with a lot of resistance. When I'm talking about areas with the resistance, I'm talking about the zones where the market once changed the direction. You can see that here the market was going up, then suddenly it changed the direction and went downward. So you have to be careful when the market is about to approach these zones so that you know whether the market is going to continue going up or it is going to drop. So basically, that is how you do it when you are now analyzing on a bigger time frame. So we can also use breakout points on bigger time frames, but we have to apply the same concept whereby the market should be going up overall. That's one. Two, we should have good candlesticks that are showing us more confidence that the market should keep on going up. So I'm going to be showing you on another pair. We are now analyzing pain X 400, which means here we'll be catching spikes going downwards. So basically, you should check the overall trend before you do anything. For instance, here we can see that on pain 400, the market is what is going up. As you can see, even if I try to draw my channel, we are going to see that it is an ascending channel. That is showing us that the market is what is going up. For instance, here this is what is happening. So guys, when the market is moving like this, catching spikes might be very hard because usually it will give you fake breakouts, which will lead you to lose your money. So the best way is to only trade when the market is what is dropping. Let's say we have what? We have a descending channel. Let me try to look for a descending channel so that we can see what I'm trying to elaborate here. This is a typical example of a descending channel. If you try to catch your spikes when the channel is looking like this, it is quite simple for you to make profit. That's the first thing you should note. The second thing you should take note of is to know the current candlesticks, right? For instance, here, the latest candlesticks, we have green candlesticks here, which is showing us that the market is what is bullish and the market is what is going up. So here, basically, the market is going up. So in the event that we are trying to catch spikes here, we have to know that we are just scalping. When the market is making these kind of movements, guys, as you can see, we have two bullish candlesticks, which is showing us that the market is what is going up. So in the event that you want to catch spikes, you have to know that you're just going to catch at least one or two spikes. So basically that is something you should take note of. So we are now moving on to the 1 minute time frame so that we see what is happening on the 1 minute time frame. So basically this is what is happening on the 1 minute time frame. So I'm just going to delete this channel so that we can see clearly. So basically on the 1 minute time frame, this is what we are seeing. We can see that the market once reached this zone with a lot of resistance. But this is the zone I'm talking about. The market once reached this zone with a lot of resistance. As you can see, the market was failing to cross this zone. It was just reaching this zone, then spikes, reached this zone, spike. But now it has crossed that zone. So it means there's a higher probability that the market should go up until it reaches maybe the next resistant area, which could be this one. So we are saying the market can go up, but the safest zone to enter this trade will be this one. The highest point that you are seeing on your 1 minute time frame. So basically, we are analyzing using the laptop. That's why it's easier for us to see the highest point on 1 minute time frame. So this is the point which would be safe for you to enter your sell positions and enjoy a downward movement. It's the same thing that I was talking about when we were analyzing KNX 400. We have to wait for the market to reach the zone where it once changed the direction. Here the market was going up, then it changed the direction around this zone. So we have to wait for the market to pull back to that zone. Then we wait for us to enter that trade. So basically, these are the certain things you should take a look at when you're trading.